Amid elevated inflation and high interest rates, the commercial real estate sector has faced its share of challenges, especially within the office space. And our next guest says those challenges, particularly that the U.S. is facing, aren't going to go away this year. For more, let's bring in Mintz. He's managing partner at Steady Capital, a private equity firm that invests in U.S. commercial real estate. Mint, thanks so much for coming in.
Hey, thanks for having me.
So, yeah, what are you seeing big picture-wise right now?
Thematically, if we were to compare 2023 to 2024, I'd say we're doing better. If we were falling out of the sky last year, I think this year we see the ground coming at us at a very fast rate. But overall, I think now that we see the problems in the market and people are understanding what the real risks are and the issues, I think everyone's working toward a solution. And so in that respect, it's looking a little bit better, but there's still going to be a lot of turbulence, particularly with big balance sheet banks having to work out these issues with office loans and various non-performing loans.
Okay, so the clarity that you're experiencing, that the industry is experiencing, what problems are the biggest right now? What are the solutions that you're saying that are coming to light?
And so I think the biggest issue has constantly been the capital structure issue, not necessarily the performance of the vast majority of commercial real estate asset classes. Office being kind of the biggest pain and where the most pain is being felt. And so people are now understanding. I see, apartment buildings are being let. Rents are stabilizing. Some markets rents are going down where there's too much supply. Some markets that are tight, rents are going up. And so these are all signs of a healthy, functioning real estate market. And so a lot of it's boiled down to, well, if you borrowed at 3% and you're facing a refinancing at 6% and your mortgage costs are doubling, there's something that needs to be addressed. And these are the big issues kind of remaining on bank balance sheets.
So when you're thinking about big buildings and big mortgages, for in the commercial space, how does that, what are some of the implications from that? Are you seeing a lot of owners of property trying to get rid of what they're holding, passing it on, or what are you seeing?
Well, in the U.S., we have a lot of non-recourse borrowing, which means you're not, guaranteed to pay the loan back. And so a variety of players and blue chip players as well, if the loan balance is so, out of valuation with what you can refinance the debt with, even players like Blackstone and Brookfield have given up buildings. They've just given the keys back and said, I'm done. But at the same time, if there's some value to be found in between, what everyone could do is get together. They'll do loan modifications. A lot of banks have modified their loans to extend them a little out. A lot of borrowers have put in more capital if they see value in the building and they want to keep it. And these are all kind of signs of recovery and more of these workouts that are being done need to continually be executed on for the next 2 years. There's still $1 trillion of commercial real estate debt maturing in the next 18 months. And so about $500 billion of that last year was kicked to this year. And so we have these issues. We're working on them. Now, will most of that be refinanced? Probably not. But there'll be haircuts. And I think banks have a playbook now. They spent a lot of last year figuring out what to do. This year is all about execution. The Federal Reserve in the U.S. and the FDIC, which regulates and provides guidance to these banks, they're trying to figure out creative ways to help them restructure these loans as well.
Is the office space still, the biggest sort of pain point or have the most question marks sort of hanging over it right now? Yeah,
unfortunately, hybrid work is still a thing. It's a lot stickier than I think people were assuming. And whichever side of the battlefield on that you kind of anchor into, it's still apparent in the metrics and the occupancy and the leasing. And so office tends to be a pretty big pain point still.
And there's interest in the residential space, though, that seems to be...
oh, absolutely.
Yeah, quite active. Yeah.
It's one of the deepest markets in the U.S. And, the agencies in the U.S. government underwrites and backs that that market, and so agency financing. And so, it's very fluid, it's dynamic, it's very deep. It's when you talk about transitional, not great office buildings where no lender wants to touch it. And this is where a lot of private capital has now been raised and is now stepping into, we call it private credit or private equity. And they're kind of filling the role that banks have vacated. And so, that's, all positive. It's capitalism at its finest. So.
I'm curious what you think of, there was a deal recently with the private equity firm Blackstone acquiring Tricon Residential. It's the Canadian rental housing firm. And it seemed like, a pretty big deal in the sense that it was about $3.5 billion for this. But that interest from this firm in the rental housing space in particular.
Yeah, it's, some might say, the SFR, BTR business, single family rental businesses, kind of like, is it pro or con? Is it, bad for the market? I'm not an expert on that, but that deal was a really good sign. Tricon Residential is a huge homeowner in the U.S. And Blackstone is a huge player. $3 billion is a lot of money, but Blackstone I think raised $15 or $20 billion. So that's one of many deals they'll do.
Right.
But the nice thing is that if you read a certain periodical, you'll hear Blackstone giving buildings back, but they're still also investing, and so. Brookfield as well. And so, they're figuring out, what they want to get rid of in their portfolio that, they can't save, and that's healthy. And now they're looking at their dry powder and saying, we should be investing in this market. Returns have rebalanced. It's a much healthier market, higher return. And so they're all in the business of generating return.